Yes, indeed, a strong performance from the marketplace with revenues up 12%, about 7% of that accounted for by price and 4% accounted by volume. And then, of course, the benefits coming through now of higher interest rates on the substantial amounts of cash that we hold to pay claims. But I would also point out that we've been remediating our portfolio over a number of years, and we're now benefiting from greater underwriting disciplines. So all of those have contributed to a very strong performance.
I want to bring up the solvency levels here. Market-wide solvency coverage ratio, 207%, up from 181% year prior. How normal are these figures? Is this just a high water level?
Well, they're flattered in part by interest rates, for instance, and they can be quite volatile. But the key message really is that we need to have sufficient capital to pay a growing number of claims coming from a broader range of issues globally. And financial stability is a key tenet of honouring our promise to pay our claims.
Bruce, Mandy jumping in here. High premiums and rising premiums has become quite a political hot potato in many parts of the world, indeed leading some people to even have to drop their insurance if they can't afford it anymore. What considerations do you have in terms of deciding whether or not those premiums will continue to rise, and is that your expectation that they will keep on going higher?
Well, a substantial contributor to rising prices has been inflation, of course. So we're seeing our claims inflated as the cost of replacement increases dramatically. But it's also important that the industry returns its cost of capital. And this hasn't happened really on average over the last 10 years. So this is really the first year where the industry is beginning to make a decent return on its capital. And that return is incredibly important to attract new capital to support risk-taking. We are seeing the level of price rises flattening off. We're not seeing them decline at this point, but we expect pricing to be reasonably stable through 2024.